Okay, hello folks. Sorry for the late start. We got Thursday, October 3rd, and we're here again, ready to get to work. So first thing, I wanted to take a look at where we are at. My schedule um, is revised. Okay, I just got to get what we have revised. Is that a word? Revised on Brightspace. So this is the existing schedule, all right? And you remember I missed a day on the 23rd there. Or no, not the 23rd. This is a different class. So our schedule actually is what is shown here, right? It's the Monday class I had to revise. So we are on the third, and we have a little bit of chapter 3 to do, and we'll actually get a start today in chapter 4. Okay. So I'm going to go over the homework assignment. Now I'm going to do that in detail because I got some questions from a couple students about some of the steps. And, since it's got a little bit of complexity to it, reasonable amount of complexity, we'll go over it in detail. Once that is done, we'll go ahead and get a start in chapter 4. And, I'll make that material available for you on Brightspace, and then we'll go ahead and get right into that. We'll get a good solid start with that today. And then homework going into class for Tuesday will be another problem associated with the adjusting entries, posting to the ledgers, and of course, creating a trial balance. But what I'm going to do this time is instead of a trial balance, I'm going to have you, jump back into creating financial statements. Okay. So the third piece will also include, or third and fourth piece, the adjusted trial balance, and then having you working on some of these financial statements, the income statement, owner's equity, and of course the balance sheet. All right. So the homework will be a single problem that does all those things, and I'll have you work on that going into Tuesday. So that's really what's on the agenda today. So let's go ahead. For all intents and purposes, we've pretty much finished chapter 3. We got this homework we'll go over, very carefully and address any questions that anybody has about that. And then we'll go ahead and jump into chapter 4 here. Okay. All right. So having said that, let's go ahead and jump in to the homework. And so I've got a number of questions. I didn't have a whole bunch of students emailing me, but I had maybe about 3, possibly 4. Um, that had some questions along the way. So first things first, what I want to do is jump in here, and I'm going to put this actually in our notes. Okay, so I'm going to grab the chapter 3 notes, and we're going to do some calculations just like we did in the in-class problem or exercise that I reviewed. So I'm going to go down and actually copy one of these areas here. Let me see. Let me just grab maybe the first one here. So the format will be very similar. You'll have the transaction, you'll have the notes related to it, and then then we can kind of dig into what the calculations were. If I need to take a screenshot or something to, clarify where an amount came from, I'll go ahead and do that. All right, so let me go down here and we'll put a little border under there. Okay, a little further with that. There we go. All right, and we're going to call this chapter 3, homework 3, notes. All right, appropriately labeled. All right. Now I'm going to paste this in here, and I know this is from a prior exercise, but I'm going to kind of, use this as a template to do the adjusting entries in this problem. Okay. All right. So first thing that you want to do, this is another thing we'll do, which I'll copy. Okay. I'll go to the very beginning here, or any one of them really, that had this. We want to know what our time period assumption is. So I'm going to copy this and bring this down because it may be the same. It might be different. Who knows? But we're about the same. All right, as we review this. All right, so we'll paste that in there. And I'll say accounting. Whoops, that's not the font size I want. So I'll just grab this. I'm gonna put this down here. So we'll say accounting cycle time period assumption is, and that's to be continued once we review that. All right. All right. So again, we had a single problem in there. Let's go ahead and read the problem. Once I find my cursor, wherever that went. There we go. All right. So let me zoom in a little bit. So, and we reviewed this at the end of our class on Tuesday. And, I just gave you some tips on how to work on part B and some stuff with C. Well, let's go ahead and read it again and, start fresh with this. So Logan Krause started her own consulting firm, Krause Consulting, on May 1st. And then the trial balance for May 31st is as follows. I'm actually going to go into my instructor mode because I can select the text in my view. So let me just go back right in there and right back where we were. Click into that because I want to be able to copy and paste these transactions into the notes. Okay. All right. So let me go down and click into the problem. I'll expand it, of course. All right. So here we are again. So Logan Krause, started her own consulting firm, Krause Consulting, on May 1st, 2022. The trial balance, speaking great today. May 31st is as follows. All right. So there's the very first thing that we notice. All right. She started the business on May 1st. Her very first trial balance that she's creating at the end of her first cycle is at May 31st. So let's put that in here first. I'm going to say all adjusting entries are prepared at the end. Okay. End. Whoops. Of May. And that would be May 31st, 2022. Okay. So the accounting cycle or the time period such assumption is 1 month. All right. So 1 month. Now, this is beginning information that's really important because as you remember, some of these adjusting entries that we're going to do involve the time factor. All right. Some of these, it matters how much time has gone by. Some, it doesn't. All right. So we have to know what our time period assumption is. We know that now. And then we know that at the end, not the ed of May, that would be May 31st, 2022 for the end of our cycle. All right. And we know it's 1 month in length. All right. So that's the very first thing that we want to put in there. So going back to the problem. All right. We got our trial balance here, which we will reflect on as needed. All right. It has some beginning balances, existing balances for all of our accounts. Debits equals credits in the trial balance as it should. Okay. So we have a full-fledged trial balance there. Then we have, in addition to those accounts listed on a trial balance, the chart of accounts for Krause Consulting also contains the following accounts, right? And then you got a laundry list of accounts that more than likely you would be using for adjusting entries, okay? They're not on our initial trial balance, all right, as you see up here. But once we complete some of our adjusting entries, they will now become part of our adjusted trial balance. All right, our second trial balance. So in other data, we got 7 things. Obviously, we're going to go through that with a fine-tooth comb, both with the calculations that are needed to get the number for your journal entry, and then what the journal entry will be as a result, okay? Which is another thing I want to do. I'm going to go into our content area, and I'm going to pull up. So again, this is another detailed look at this, and I want to make sure that we do that. In our Chapter 3 folder or area, that last lesson, I'm going to pull up once again 2 of them, right? Because I want to be able to review the templates, and I want to be able to review. I'm going to push this way over here, so none of that's in my way. There we go. So if you remember, we had our deferrals and accruals, but then we kind of sorted this by either revenue related or expense related. We kind of sorted them that way. And then over here, we had the actual templates. Okay, so, and we'll kind of look at these to figure out, all right, what am I debiting and crediting generally? And then we come up with the specific account titles that will go in those debit and credit areas, depending on what kind of an adjusting entry you have. So I want to revisit that as well. So part of this is identifying what type of entry we are dealing with. And then once we know what type we're dealing with, we'll look at the template and figure out what accounts would be appropriate for that particular adjusting entry, okay? So I'll have that up there and we'll go back to the problem and then we'll go ahead and get started. All right, so your instructions in part A is prepare the adjusting entries for the month of May. All right, great. We already know our time period assumption is 1 full month. That's our accounting cycle. So I'm going to go ahead and just like I did with the drill we did in class, I'm going to copy in the transaction. Okay. All right. And I'm going to, let me undo that. And I'm going to put that right smack dab in the middle there. So it keeps the formatting and it doesn't keep the formatting. That's okay. Where's that format painter? There we go. One of my favorite tools in Microsoft Office is the format painter. Yeah, you copy a format from one string of text, and then you use it for, to format anything else that you want to apply the same formatting to. All right. So I'm going to get rid of this because we don't need that. All right. And we'll leave the old journal entry in there to keep the format, but this is where we'll prepare the entry. And then we'll see what that looks like in Wiley Plus, do a kind of a contrast and compare thing. All right, so first one says, and I'm going to delete this because we're going to identify these as we go. $900 of supplies have been used during the month. So when we're talking about the use of supplies, would that be a revenue related thing or an expense related thing? It would be a what? Expense related thing. So then the revenue choices are not applicable. Now we're looking at either accrued expenses or prepaid expenses. So an accrued expense is just an expense that is accumulated over time. A prepaid expense is where something was originally booked as an asset, and now we're charging it to expense with use of that asset. So which one does this more closely resemble? It's a prepaid expense. You got it. Yep. Because the supplies were bought up front, and now we are noting that some of them have been used. All right. So that's a prepaid expense type of an adjusting entry. All right. Now, what we are looking for when supplies are used is the actual amount of supplies that have been used. All right. And this got a couple students because what they did was they went up to the previous thing we did in class, which I think was the first journal entry. Let me see. I think it was number 1. Or number 2. All right. The drill that we did in class, the exercise, said account of supplies on December 31st, 2022 indicated that supplies of 900, same number too, coincidentally, are on hand. Now, remember, when you see on hand as a phrase, they're telling you in that sentence what is actually left over. What was left over, not what was used, okay? So in order to figure out what we used, if you remember, we had to take our original balance, which I have a screenshot of here, all right, of 2,450, subtract what we have left over or on hand, and then that's how we backed into what must have been used, okay? Now, fast forward to this current one that we're doing down here. They gave you information, slightly different information. They told you that $900 of supplies have been used. So right there is what we need. That was the thing that we need. In fact, I'm even going to underline that. All right. That's what we're looking for. So for this version here, we didn't have to calculate anything. All right. So we have the number we need. $900 is what we used, and that's what we need. So for now, I'm just going to put that right in there. All right. So be mindful of when they give you numbers, is it the amount left over or on hand, or is it the amount that was actually used? If it's the amount that was actually used, that's the number you need. All right. You don't have to back into it like we did with that exercise. Okay. But what some students did, and again, you were just trying to follow what, we did before, but you just missed the detail that, have been used means that there's your number. Okay. They went up here, they grabbed the supplies balance in 1900, subtracted the 900 and got 1,000, right? Now, by doing that, what you did was you took the amount that was left over and you charged that to your expense account. And that was the opposite of what you needed. When you're adjusting the supplies or the prepaid insurance or prepaid rent, whatever it is that was bought up front as something that can be expended and used, you're looking for the amount that was used, all right? That's what we're looking for. The amount of insurance that was used up, the amount of rent that was used up that we prepaid for. That's your target. Okay. So this gave us that. All right. So that caught some of you where you thought, oh, $1,000. Now you hopefully now you know that's why that number is not applicable. So I'm going to put a little extra blurb in here. This entry, we are looking for the amount of supplies that was used up. All right. And again, I underlined have been used because I just want to reinforce that's the number you need. That's your target. All right. Now we know we have a prepaid expense. All right. We go to the template for that. And there it is. All right. So you're going to debit an expense account and you're going to credit an asset account. All right. So when you're looking for an expense title, you take what it is that you're expensing and tack the word expense on it. So what are we using up? We're using up supplies. Well, supplies. Yep. $900 worth. Exactly. So we'll take supplies and tack the word expense on. So supplies expense. There's your expense account. Now, again, with these adjusting entries, be very specific. All right. And then we're going to credit an asset. Now, when we credit an asset, as you know from your debit credit rules, that crediting any asset decreases it. In fact, I have a little reminder here what you're doing when you do that. So which asset makes sense to decrease? We're going to decrease the supplies. Yep. Because if we don't, if I go back to the problem here, way up here, the supplies account has a balance of 1,900, right? But after we realized that we have 900 supplies used, do we really have 1,900? No, we're down to 1,000 at that point. So we got to take 1,900 off this balance to bring it down to what we have left over. All right. So, and that is what you do in the adjusting entry. So we already got our number in there. So this would be supplies expense. And then your credit would be a decrease to the supplies asset account. All right. And push that over there to make it look like a credit. Oops, a typo. There we go. All right. So there's your adjusting entry. All right. Now, additional reinforcement. Every adjusting entry has one income statement account and one balance sheet account. All right. So the income statement account is supplies expense. All right. Because on the income statement, we have revenues and expenses. The balance sheet account is the asset supplies. So you're either looking for an asset or a liability. And which one is which really depends on which adjusting entry you're doing. Okay. Because some of them will require an asset to be used. Others will require a liability to be used for the balance sheet account. All right. So always one of each, either revenue or expense. And then the balance sheet account would be either asset or liability. So when we go into the problem and see how this looks in Wiley Plus, same format here. Let me expand the question. Minimize the question. Oh, it's not supposed to do that unless I'm zoomed out too far. Yeah, I think I'm zoomed out too far. Yeah. Yeah, expand question is supposed to make it so I don't have to do what I just did. Oh, well. All right, let me just zoom in browser-wise to make that better. There we go. Yeah, so there's your first adjusting entry, supplies expense and supplies. And again, the other thing I told you when the setup of the problem, just ignore these reference numbers, all right? You don't have to worry about those. I'll talk about those again when we get to part B, all right? So we're just looking at the journal entry here. And again, one debit, one credit, no numbers in these opposing columns, all right? Otherwise, it'll mark everything wrong. Yeah, just basic journal entry format, which Wiley Plus's version matches what I got in the notes here, all right? Generally speaking. Debits are left, credits are right. That's the debit column, that's the credit column. All right, so all the numbers that you calculate are done outside of the journal entry. Once you get the number, then you pull that in to your adjusting entry and prepare the entry, okay? All right, so I'm gonna go ahead and copy all this and we'll do the same thing. We'll keep working our way through these. And between what I did with the in-class exercise and this should set you up nicely for what I am going to give you for homework for Tuesday. All right, so let me erase the journal entry type, adjusting entry type, and let's go look at the next transaction here. All right, so let me copy that right into our notes. And I'm going to paste that in there. And once again, it doesn't, must be because the ebook is better at keeping the format than this is. All right, no problem. I can just kind of change the format. All right. So next one says utilities expense incurred, but not paid on May 31st, 2022 is $250. All right. When I ask you what type we're dealing with, clearly is it revenue or expense related? It's obviously expense related. So from there, is it an accrued expense where the expense just accumulated over time? Or is it an asset we bought up front that we are charging to expense with use? Which one makes more sense? Accrued expense. Yep. Utilities, the more you use them, the more you accumulate. And even though we're in October, I'm still running the air conditioning in my house. I'm one of those people that it's got to be like a refrigerator in my house. Yeah, and it's although the nights have been very cool, which is great, but I still run the damn thing. My house is too warm. All right, so now this one here, we don't have anything to calculate. They just kind of gave you what that amount is, $250. All right. So some of these you won't have to make a calculation. All right. So I'm going to go ahead and put that in 250 and 250. So there's the number you need. All right. And so we're dealing with an accrued expense. So we go and look at that template. It's right there. We are going to debit an expense account and we're going to credit or increase the liability, right? Because we got the expense, but we didn't pay for it yet. So what would be again, we look at what we're charging to expense, and then we tack the words expense onto it. So what would that be? What would be the expense account, the debit? Utilities expense. Yep. And then the liability, when you have that, well, you generally would use, if you follow the convention, and I think this is the problem that does this, it's the only one that does, you follow the convention of something payable, right? So if I was following what I did with expenses, what should my liability account be named? Utilities payable, all right? However, when I look at the solution, I know there's one problem, and I hate that they do this, where they actually used accounts payable. And I think that's what this one is. Yeah. Now, had I remembered that at the time I assigned this, I probably would have given you a heads up about that. All right. But this is the only problem in the entire chapter or anywhere in the book that does this. And, one of the suggestions I told them when they get my feedback is, change that to utilities payable, because every single other utility, accrued expense you have in every other problem or exercise uses utilities payable. But no, they chose to use accounts payable. All right. But if I was doing this journal entry, and I'm actually going to put this in the notes, all right, I will put what they've got, but I'm going to put a little blurb in there. So utilities expense, and it should be utilities payable. I'm going to put accounts payable. All right, no problem. But then I'm going to get a little asterisk here, and I'm going to put a little explainer in there, because I don't want you guys to think, oh yeah, accounts payable is good to use. No, it's not. In fact, they shouldn't have used it here. So my little blurb below is going to do this. I'm going to put the little asterisk, and I'm going to say solution in the Wiley Plus problem used accounts payable as the liability. However, it should have used utilities payable. Yes. Yes. Yeah. So question was, is with the liability, is it similar to what you do with the technique for the expense? You take whatever it is and tack the word expense on. Yes, you do the same thing with liability. So technically, if they were consistent, which again, this is the only time they do this, which kind of, makes things difficult for me because I have to do what I'm doing now. I have to kind of give you a disclaimer here. That technically it should have been utilities payable. So again, you take the expense and the payable and you just tack on what it is. All right. So utilities expense, utilities payable. As I said before in the other classes, be specific. All right. You want to make sure that your account titles are not general like accounts payable anymore. They're at least with the adjusting entries, you want it to be very specific to the thing that you have a liability for. Yep. So I just want to throw that little blurb in there. So when you're reviewing these notes, and you're thinking, why is it accounts payable here, but in everywhere else we've seen it, it's utilities payable. I just want to throw in that's what it should have been. Okay. So I got an email last week asking for more feedback. What I'm going to do is I'm going to give them feedback, and then I'm going to request to meet with somebody from Wiley, either in person or through a Zoom meeting, so I can tell them verbally what I wrote. Because I have a feeling that I submit this, feedback, and nobody's looking at it, or somebody's looking at it and not moving it forward to the design team or whatever. But I'm really going to dig a little deeper this time and say, listen, there's some things I noticed that I've mentioned that you should fix with this. It's a great product, but here's some things that I have suggestions for that, and other professors I've talked to at other colleges had the same exact things. I went to a conference, and there's a whole table of accounting professors and that used Wiley products. And that was one of our biggest gripes that we had, is we were comparing notes about stuff, little things like that. And then our opinions are asked for, but then nothing's done with it. So I don't know where that disconnect in communication is happening. So I'm going to request to actually meet a rep, either virtually or in person, to discuss that. So, because that should be utilities payable. All right. But at least in my notes, I verify that or clarify that. So you don't get confused. Why is it accounts payable in that problem, but the next problem they use utilities payable? All right. So there it is. All right. I'm going to go ahead, and like I did before, I'll copy this template. But we know that before I do that, that's an accrued expense. We already figured that out. All right, I'm going to write that in. And whoops, let me pull that in for the next one. All right, so this will be adjusting entry 3. And of course, again, we'll clear out the adjustment and pull in the data. All right, so next one we got. All right, let me copy that in and we'll take a look. All right. Oops, the cursor just disappears and there we go. Grab the old format painter and format that accordingly, and then get rid of this. Okay. So an insurance policy for 2 years was purchased on May 1st. All right. So we know that our cycle is only for 1 month, right? All right. In fact, I'm going to just pull that information in here and remind us about that in journal entry number 3. Because here's one where the time factor is important. All right. The time factor is important. So now that we know that, we know that if we go into the prepaid insurance item up here, and I'm even going to do this, I want to grab a screen of that, and I'm going to pull it in for a document. All right, let's see. Add a little border to that, and I'm going to say copy all, and then get rid of that, and we'll pull it right into our notes. All right, because I want to make a little point about that. All right. So, in fact, I'll do a better version. Let me get a better version of that. Because there's one little thing I want to do here. Editor. All right, and I'm going to take the shape, and I'm just going to select that right there. I want to make sure that that's highlighted. All right, so we'll copy all that. We'll throw it in the notes. So this is from the trial balance, of course. And you notice that we got a $3,600 balance. It's a 2-year policy. All right. So that's the amount that went in the account for the policy. Right now, we have to figure out how much we need, and that's where this situation is extremely important. Okay. So if yellow highlight that for emphasis. We only need 1 month's worth of insurance. Here we got a 2-year policy. So we're going to take the 3,600 and I'll put 2-year policy. And we're going to divide it by 24 months. All right. And that's going to give us the amount for 1 month. All right. So if I get my calculator, I know the math is easy, but let's run through it. 2,400, I'm sorry, 3,600. All right. Divided by 24 total months, 2 years, 12 months in a year, get 150. All right. So this would be 150. And we'll say insurance used in 1 month. Okay. And again, the operative word is used. That's what we're looking for. What was used up? And that's the number that we need for our adjusting entry. Okay. So if you use 3,600, you expense all 2 years worth of insurance in 1 month. All right. There's really not, obviously, that's not how we do that. All right. You paid up front for a 2-year policy and you only used 1 month of it. So now we haven't done this yet, but when I go to the adjusting entry types, is this revenue or expense related? It is what? Expense related. So is it an accrued expense where expense is accumulated over time, or is it a prepaid expense where we bought an asset up front that we are now adjusting or charging some of it to expense? Which one makes more sense? It's a prepaid expense. All right. The answers are coming quicker with that, which means that you guys, as you've been working on this, it's starting to connect a little bit, and that's good. So that repetition is breeding familiarity. That's awesome. So now that we know that it's a prepaid, the prepaid expense template, we're going to debit an expense. What are we expensing here? Insurance. So what's the name of my expense account? Insurance expense. And then we're going to credit or decrease an asset. Which one makes sense to decrease here? Because we use some of it. I'll give you a hint. It's in my screenshot. That's a really good hint. All right. So your debit or your expense account is going to be insurance expense. All right. There's your income statement account. And then the balance sheet account is going to be the prepaid insurance asset account. All right. And we're taking 150 off, which is going to, take the balance down from 3,600 to 3,450. Okay. So that we use some of it up, and we have to recognize the amount we used up. Yes. Yeah. And the operative word is prepaid. Money spent up front to acquire that. It comes onto the books as an asset, something you paid up front for, and it's going to benefit future periods. Okay. Yep. No, that is a great question to ask. So the question was anything with the word prepaid in it, generally is going to be an asset. And that is correct. So you get prepaid insurance, prepaid rent would be another one that we saw. The other thing that you bought up front but doesn't have the word prepaid in it would be the supplies thing that we saw. Yeah. So you wouldn't see like prepaid supplies, but essentially that's what you've done. You bought them up front, but then when they put the account on the books, they just call it supplies. Yeah, that would be the exception there. All right. So, and again, seeing how this lines up in Wiley Plus, the journal entry for that third one, again, exactly the same as what I've got in my notes. All right. The format is essentially, represented here that was represented in notes. Debited accounts first, credited accounts second. Make sure your numbers are in the respective debit credit columns. All right. Let's look at the fourth one here. Yeah. All right. This is a good one. This is another one where you could really kind of state it two different ways. You know what? First, let me go ahead and copy my format. I'll take, so let me put this in. That was the prepaid insurance. No, expense adjusting entry. Let me grab this template up here that doesn't have as much stuff in it. All right. There we go. All right, copy that, and we'll bring it down. So this one involves, unearned amounts. Okay, so let me get rid of this. Let me pull in the transaction. Let me copy it one more time. All right. Pull that guy in there and then give it some formatting. All right, try to stay consistent with that as much as I can. All right. And I don't know, why'd that come in as a table? It's weird. Here, let me pull it in, a blank Word file or Notepad file. Yeah, that's weird. Paste it in as a table. Yeah, there's some kind of thing in front of it. All right. I can fix that. Bear with me. Okay, so there it is. All right. And that might be the thing I need to do to strip the formatting off it. All right. So we're going to get rid of this. And what did I do? Squeeze that in the wrong spot? I did, didn't I? This is 3, and that was 2. What did I do? I copied 2 again, didn't I? All right, yeah, so I don't need this. Let me get rid of this. Sorry about that. Okay. All right, so it's $400 in the of the balance in the unearned service revenue account remains unearned, and that's the key. I'm going to actually bold that. All right, that's the most important part. All right, so if we're talking about unearned service revenue, what adjusting entry type are we talking about? It's an unearned revenue. It's definitely revenue related, and of course, it's an unearned revenue type of adjustment, right? So that's the first thing I want to do. I want to go in here and put in that it's an unearned revenue type of adjustment, okay? So what they're telling us here, remains unearned means that, originally we got paid up front for work that we did not do yet. And later on, when we actually performed the work or the service for the customer, we now can book the revenue. All right. So that's why we call this an unearned revenue type of an adjusting entry. So what we have to figure out here, all right, we need to figure out how much revenue was actually earned. All right. So what they're telling us here is what remains unearned, meaning we have not earned it yet. So what we got to do, and again, I'm going to go in here and I'm going to go to my trial balance up here, and I'm going to take another screenshot so we can lock this in. All right. All right. And then once again, I'm going to draw attention to that number. All right. All right. So I'm going to pull that in, and I'm going to actually copy all that in, put some notation on this again once I do that. All right, so let's pull this in here. So when we got paid up front by the customer, we put a balance in our unearned service revenue liability account of $2,000. So that was our original balance. So now they're telling us, okay, we'll go down the line. So I need a line for calculations. There we go. Go down a little more. So we had 2,000 $2,000 is our original amount. Original amount owed for services, we'll call that. Right. And I'm going to bring that font size up a little bit. That's a little smallish. There we go. That's better. Minus the amount that we still owe. All right, the $400. And we'll call this amount still owed for services. All right, and that's going to give us the amount we must have earned. So we'll label that amount of revenue that must have been earned. All right, because again, with the supplies, you're looking at what was used up. With unearned revenue, you're looking at what was earned, what was actually earned. Okay. So what they did, similar to the one scenario with the supplies, they gave you what you originally had for a balance. Then they told you how much was left. And then you had to kind of back into it. You had to say, all right, originally we owed $2,000 worth of supply or worth services, and 400 at the end of the cycle is still owed. So the difference must be what we have earned, the work that we must have done. Okay. So once again, kind of showing where the ledger account is and its balance. And then that's going to be our number. Yes, sir. Yeah. credited 1,600 to which account? Well, when you credit a liability, what's that do to it? Yeah. Yep. Well, actually, I'm sorry, go ahead. I didn't mean to interrupt you. Well, and actually to clarify what I was going to say, before I interrupt you, when I shouldn't mean to. This is an unearned revenue adjustment. So like when we look at that template, we're going to debit or decrease the liability, and which one would we debit or decrease? So instead of crediting it, we would want to debit it. And the logic behind that, again, if I go to the notes, is we have this balance in here originally, okay? And when they're telling us at the end, we only have 400 left that we owe, we're going to have to take some off of this to reflect what is still left to be owed, all right? So we need to take 1,600 bucks off of this liability account. And we know in order to decrease the liability, you have to debit the liability to decrease it. So you had the right idea, you just did the wrong thing to it, which actually, again, instead of just saying it's wrong, let me tell you what you did there. You actually added on to the liability. Yeah. And when you see it that way, rather than, oh, it was just wrong, I should have debited, that's good that you acknowledge that, but when you look at what you actually did, that'll help you not do it again, because then you can see what you're doing to the account. So when we debit the account, that decreases it. And then the revenue account is increased because we've now earned that money, or that, amount that was paid to us up front. What's the account we generally use for revenue? What was the account? Service revenue. Yeah. In fact, if we go up here to the problem, you see that we got it in the list here. Okay. So there's your revenue account title. So in the notes, we got our number, and now we're just going to put the accounts in. So we're going to debit the unearned service revenue liability. That's going to decrease it, as it should be decreased. All right. And then we're going to credit service revenue. All right. Because what we used to owe in services, as of the end of the period, we realized that 1,600 of that we no longer owe because we did the work. Okay. We only had 400 left. Originally had 2,000, so 1,600 month. That's the only way you can decrease that, is by doing the work. I guess there's another way, like if you give the customer a refund, say, well, I guess we can't do the job for you, here's your money back. That's another way you can do it, but that would be a different kind of entry. Okay. So that's what's happening there. All right. So let me grab, I'll grab the first one here. It doesn't have much in there. Yeah. So we need another one for the next entry. All right. So that was the fourth one. And let me go down to a brand new page here and put the fourth one in here. Real quick, did we label this? Yeah, unearned revenue, we did. All right, so let me pull this out, and then what's that? Okay, so let's see what we got. Let's see what we're dealing with. So entry 5, or adjustment 5. Let me pull that in. And you know what? I'm just going to go ahead and throw that in my notepad, strip any formatting. So when I bring it into Word, it should be 100% formatted. Yep, perfect. That's what I'll do. That's my workaround for that little formatting thing. All right, here's a good one. May 31st is a Wednesday. This might seem familiar. We saw this before in the drill. May 31st is a Wednesday, and employees are paid on Fridays. Kraus Consulting has 2 employees who are paid $9.20 each for a 5-day work week. All right. Well, kind of like that, but a little different. All right. Well, so we'll dig into it. Now, before this, before we do this, when we're talking about salaries and wages that we owe our employees, it's a revenue or an expense related thing. It would be yeah, it's an expense because, wages and salaries are costs for the business. But then the next question is it an accrued expense, or is it an asset we bought up front that we're now adjusting in value, AKA a prepaid expense? Which one makes more sense? Yeah, it's an accrued expense. And again, salaries, wages, interest, those are all accrued expense examples. You have perfect examples of them. So we'll go in our notes and we'll label that accrued expense. All right. All right. Now that we know that, now we got to figure out our numbers. Okay. So we know that the accounting cycle ends on a Wednesday. So for the current work week, we have Monday, Tuesday, and Wednesday before the cycle ends, right? And now the employees would love to get a check on Wednesday for part of their pay period. That's not how that works. We've had 3 days of the pay period accumulate, and we've out of a total of 5 days. So once again, we're going to do this. I'm going to take the 920, all right? I'm going to multiply that times 3. I'm going to give it an asterisk, just like I did before, over 5. I'm going to give that a double asterisk. I'm going to go down here, and I'm going to add for the current work week. And I'm going to make that the single asterisk, right? And then under that, I'm just going to throw a double in there, and I'm going to say 5 total days in a work week. So we know what the 5 represents. I mean, right now, looking at it and going over it like we are, it's clear what it is. But you want to make sure that you label that so you know what that fraction means. All right, so once we do that, we'll take our calculator, get the 920, and we multiply it times 3, divide by 5, and we get 552. Now, this is the amount for one employee. Because what may have gotten some of you is that you took that 552 and used that. Anybody do that? Well, you remember we have 2 employees. Okay. Yes, Jason. Yeah, that's another way to do it. And actually, let me say what you just said, so that's in the recording and the Zoom folks can hear it. He did it a little differently. Jason in class here, he took the 920 and divided it by 5. And then when he got that result, which actually, if I kind of did that as I did explain it, take the 990, no, not 90, 920, and you divide it by 5 individual work days. That gives you the amount per day. And then you multiply that times 3, and it'll get you the same number. Yeah. So there's another way of doing it. This is what I have here is kind of like a prorated fraction kind of thing, which I like to do. But that would be the other way to do it. Find out how much an individual employee gets paid per day, and then multiply that times 3. It's another way to get there. Absolutely. So we've got 2 employees. So 552 is only for 1 employee. So we just have to multiply that times 2, and it gives us that number. So that's the next thing I want to throw in there. 552 times 2 employees. And that's where we got the figure that I got here, which is the 1,104. Yep. Total amount accrued. All right. Why that word just does not want to stay spelled. All right, so there's our number we need. Okay. And I'm just going to go ahead and throw that into our entry down here. So we've got 1,104 and 1,104. Okay. Now that we got that in there and we know we're dealing with an accrued expense, we look at the template, all right, for accrued expenses. And we are going to debit an expense account and credit a liability. So something expense and something payable. What's the something? Yeah, in fact, if you go up and you look at your existing trial balance, we see that we have already got a balance in there, salaries and wages expense. And then the payable, of course, they give you some guidance down there. There's an actual listed account for that as well. So our journal entry is going to be salaries and wages payable, or salaries and wages expense. We'll start with that because that's our debit. And salaries and wages payable. Now, some businesses separate those, and they have individual accounts for both the expense and one for the salaries. But a lot of them just throw everything in the same deal. So there's your journal entry. And then, of course, in Wiley, that's what that is as well. Yep. And Wiley does the indentation. And I go a little further with it. I go in a little deeper, but you do see that it is indented. So, which is what it should be indented properly. Earlier versions of the software didn't do that. They had them all to the left. And I'm like, okay, that's a huge no-no because it flies in the face of what all accounting courses teach their students. We got a couple more to go. I figured we would do those and then take a break. So let's just plow through the last two here, and then we'll take a break, and then we'll come back and we'll look at the rest of the problem. So let's go ahead and enter the sixth one. All right, so make this number 6, and again, get rid of that. All right, and let me go ahead and copy the transaction here. All right. Now this one gives you a lot of information, okay? But when you're looking for the time frame that you need, you realize, hey, thanks for telling me all that. But guess what? I only need what I need. All right. So let's read this. The office furniture has a 5-year life with no salvage value. Real quick, salvage value is what you think you can get for it for scrap, or what you think the fair market value would be at the time you want to get rid of it at the end of its service life. That's what that is if you're wondering what's salvage value. It is being depreciated at $190 per month for 60 months, which, 60 months makes sense because it's 5 years, 12 months. So really what you needed was that guy right there. That's all really they needed from that. All right. So when we're talking about office furniture, and of course, depreciation, a cost, which one template wise are we working with here? Are we working with an expense related or revenue related? It's expense related. And would it be a prepaid or an accrued? All right. Well, we bought the equipment up front, right? The office furniture up front. So that's an asset, right? And now we're recognizing depreciation on it. So that would actually be a prepaid. Yep. All right. So, and that's one that's a little different because if I look at the template under prepaid expenses, we need to credit an asset, but this one we don't. We actually credit something else. Okay. So if I'm looking for something expense for my depreciation, what would I call it? You got the right idea, but for the expense, we want this guy right here. Okay. And then, yep, we know what our numbers are, but I want to hang on to what you just said because you got the other part. What was the account that we credited when we had depreciation? It was a new account. Accumulated. Yep. Accumulated depreciation. Yep. And that's your credit. Now, this one, whoops. Okay. Well, that's different. Why did that go down there? Okay, Zoom, throwing curveballs at me today. All right. Now, when we go into problem, we want to make sure that we got the right account title. So it's actually depreciation dash equipment, right? So we got to add the dash equipment in there. All right. Just be mindful of that. A lot of companies just use this generic accumulated depreciation. Others may make it more fancier and just like dash equipment, dash furniture, dash copier, whatever, and some of them have accumulated accounts for every depreciable asset they have. Others just have one generic accumulated depreciation account they throw everything into. So mileage varies in terms of how that is actually set up. So this is a prepaid expense type of an adjustment. So little blurb in the notes. Okay, I'm going to put that up, a little asterisk up here, and I'm going to put that down there. Any depreciation entries are a prepaid expense. So this gives you like a little fact that if you remember this, you'll never have to wonder again what type it is. Yeah. All right, so we got our numbers in there, we got our accounts, and of course, let's see how that looks in Wiley Plus. Yep. Exact same thing. All right. And then the last one says invoices. Well, here, let's copy it in first. Let's do that. Copy it in on here and pull this into here. Okay. Whoops. You know what? I didn't copy, or did I copy? Nope, I just undid what the work I did. So let me undo that because I want to grab a fresh copy and not put that in there. There we go. All right. Let me just grab this, copy that down first. Got the cart ahead of the horse here for a minute. All right, so this would be 7. And we'll get rid of all this because we're going to identify what we got. I'm going to go back in here and copy this. And I'm going to pull it in here. Here's our last adjusting entry. All right. And we don't need this. All right, so it says invoices representing $1,700 of services performed during the month have not been recorded as of May 1st, 31st, that is. So are we talking about revenue or expense? Which was this one related to? It would be, we're talking about performing services, we're talking about revenue. Now from there, is it revenues that we did perform, but we just didn't book? Or is it money that we got paid up front that now we are earning by performing some of the services? Which one makes more sense? Yes. So in other words, an accrued revenue. Yep. So that's what we're dealing with this. So we'll call this accrued revenue or revenues. All right, that's the type of adjusting entry, accrued revenue. Actually, it's not pluralized. That's the type of an adjusting entry it is. All right. Now that we know that, we look at the template and think, there we go. So accrued revenue, you're going to debit or increase an asset account, and we're going to credit or increase a revenue account. Well, the revenue account's pretty easy, right? What's the revenue account we've been using for services performed? It's what? Service revenue. All right. So we got that one. What asset account would be used? Now, keep in mind that we didn't record this yet, which means we probably didn't bill the customer yet, which means the customer probably didn't pay us yet. So, well, what account do you remember when a customer owes us money for work we've done? Accounts receivable. Yep, that's what I was looking for. Yep. So, yeah, our account title we need is accounts receivable. That's the asset account, belongs on the balance sheet. And then the credit, of course, to recognize the work that we have already done, service revenue, right? Remember the revenue recognition principle. If you earned it, you can book it. Services or revenue is recognized when service is performed or earned, okay? And that $1,700, there's nothing really to figure out. They just kind of told us what amount we have there. So we can just go ahead and put that right into our entry. So a couple of these you didn't even have to figure out. They gave you what you needed. Can I get all that on one line? Will that all go up there? Yep, it did. All right. And so now that we have that in place, yeah, this is your balance sheet account. All right. It's an asset. And here's your income statement account revenue. You know, income statements, revenues and expenses, balance sheet is assets and liabilities. So you always have to have one of each. Okay. All right. So, and then of course in Wiley Plus in the solution there, for the 7th one, that's what we got as well. Okay. So I wanted to take a really huge deep dive into where those numbers came from, how that got put together to give you the entries that we have here. Just like we did with the drill problem that we did, because there were some things that were, you know, the same situation, but the way they worded it, it was a little different. All right. The calculation, how to get at the numbers, we had to do a little bit, you know, and like that one with the salaries and wages was slightly different. Okay. All right. So now having said that, let's go ahead and take a break. When we come back, we'll see how the posting went, how that was supposed to look, and very carefully review that. And then we'll see how the adjusted trial balance looked. All right. So let's take a 10-minute break, folks. And I'll see you back in 10 minutes. Timer started. I'll go ahead and pause the recording. And wherever that little thing is. So now we've got all the journal entries done. All right, we're back from break. We got all the adjusting entries done. Now part B was to take each one of these line by line, like you did in chapter 2, and post them to their respective accounts. All right. Now, one thing about this that I went over in our last class is some of these, well, there was a little maintenance you had to do before you did any of that. Um, so, the lines that had a balance as the explanation and the check mark, you had to go up to the top trial balance and grab the balance that's reported there. All right, so I'm using cash as an example. And then you go down and you put that initial balance in there. Now, you do not, for those lines, put anything in the debit or credit columns, because by doing so, you're implying that that amount that you put in the balance came from a journal entry. It did not. It's actually coming from the initial balances at the top. And so anything with the word balance in it, you're just grabbing the trial balance numbers at the top. All right. And that kind of repeats what I said when I, showed you the assignment when I signed it. But anything else that has adjusting, obviously you're getting a post from an adjusting entry. So, kind of following one of the adjusting entries. So supplies expense was debited for $900. So we go down to the supplies expense account, which is a little further down here. And we, the date is in there. I think the dates were kind of hard coded, so you didn't have to do that. Journal page number was as well. So you had to put the number in. All right. So we debited supplies expense. So that's where the number goes. And an expense account is a normal debit balance. So that debit post raised the balance to 900. Now, if Wiley had given you the option to do this, you would take that number 631 for the account and go back up to your journal page and put the 631 in there. But they chose to do that for you, so you didn't have to do that. But when you post to the ledgers, you have to cross post it back and put that number in that line in the journal entry to show that you have posted that portion of the entry to the general ledger account. And then supplies is credited for $900. So we go down and find the supplies account, and we got our initial balance in there, of course. All right. We put everything else is put in here for you, but you put a $900 credit. We know that supplies is an asset. So by putting a credit in there, that's actually the decreasing side of that account. And it's going to lower the balance from 1,900 down to 1,000. Okay. Now you should be able to take that 126, which is the account number, and go back and put that in there like they did here for you. All right. Now, I don't mind Wiley helping out, but when I'm, wanting you to do this and learn how to do this, having them preemptively do it for you doesn't really reinforce the posting process. All right. So I figured at least with this first one, I can show you what the intent was, what you should be doing that Wiley did for you. Okay. So all the other entries that we have here, all right, get posted to their respective accounts. Okay. In the same manner that I just did the first one. So you see accounts receivable has its initial balance, and then it picks up a debit post from an adjusting entry, which raises its balance to 7,700. So again, remember, look at the account you're dealing with. What type is it? And then what's its normal balance? All right. So whatever you post from the journal entries, you literally match what's done in the entry. If it's debited in the entry, you put it in the debit column. If it's credited, it goes in the credit column. Once you get that number in there, then you have to assess, all right, did this debit or credit post increase or decrease my balance? And that's where that normal balance stuff comes into play that we were working on in chapter 2. So accounts receivable is an asset with a normal debit balance. So that means the debits are the increasing side, credits are the decreasing side. So by that debit post is going to raise my balance from 6,000 to 7,700. All right. Looking down at the other posts, we got supplies, prepaid insurance and equipment, all of which are assets. So notice with supplies, again, we got a $1,900 balance, but we posted a $900 credit. That's going to lower the balance to $1,000. Or you just subtract the credit from the previous balance. Prepaid insurance, same deal. We got a $150 credit post from an adjusting entry, which, credits are the decreasing side for this account. So it brings my balance down to 3,450. Equipment was just a balance pull down. Nothing really happened with that. Accumulated depreciation didn't have a beginning balance because it wasn't on the books for the trial balance, but now it picks up a balance from the adjusting entries. So this is a contra asset, all right, has a normal credit balance. So credits increase this account, debits decrease it. And we go ahead and put the 190 updated balance. Okay. Accounts payable. Now we're going into the liability area. All right. So now the normal balances are the opposite. They have a normal credit balance. Credits are the increasing side and debits are the decreasing side. So when we posted one of the adjusting entries as a credit to this account, 250, we went down from 4,500, or I'm sorry, we went up because credit is the normal balance side. All right. We added the 250 to the 4,500 to get 4,750. Yeah. So unearned service revenue, also a liability. We got a debit post of 1,600, which again, that would be the decreasing side for liability. We go from 2,000 down to 400. All right. And salaries and wages payable picks up a credit balance of 11,000 or 1,104. All right. Nothing with owner's capital. All we did with that is just bring the balance forward. Okay. Now we had owner's capital wasn't involved in any adjusting entries, nor will it be. Service revenue had a few posts. We had our initial balance and all the recognition that we did, whether it was an unearned revenue or an accrued revenue, credited the service revenue account. Revenues have a normal credit balance, which means credits are the increasing side or carrying side and debits are the decreasing side. So every credit post we put in here raised our balance by those respective amounts. So we end up with a final total here of 12,800. And then your expenses, some of them had a previous balance from the trial balance, some did not. The first three here, supplies, depreciation, and insurance, went on the books as a result of an adjusting entry. So they picked up balances as a result of adjusting entries, and they were established at that time. So they are all debited as they were in the adjusting entry. Okay. And expenses all have a normal debit balance like assets. So anything in the debit column raises the balance. Anything in the credit column would decrease the balance. Okay. All right. So they're all debits, and that's why all the balances match what the debits were. Salaries and wages expense did have a previous balance. And then we had an adjusting entry that added another 1,104 on the debit side. And that raised it to 7,504. Yeah. And then the rent expense and utilities are the last two. And both, while the rent expense had an existing balance, it wasn't used in an adjusting entry. So there's that. And utilities we didn't have before on the trial balance, but now we do, or we will for the adjusted trial balance, because this account picked up a balance as a result of an adjusting entry. Okay. So again, just like all the other expenses, normal debit balance. So anything in the debit column raises the balance. So that's what you should have had for all the postings to the ledgers. And again, be mindful, because you'll probably see this again where you have a balance line. And remember, don't put anything in the debit or credit columns, all right? Because that implies that, you know, the amount that you're putting in there came from a journal entry, which when you're just putting the initial balances in, you're just pulling that information from the trial balance, all right? So don't, you know, leave these two guys blank and just put the balance in there for any line that just says balance. Anything marked adjusting is the explanation. Obviously, you know what needs to go in there, okay? And then just be mindful of your normal balances. So if you post a debit to something, again, which matches what you did in the journal entry, just be sure that, you know your normal balances. So you are, not subtracting it when it should be added and adding it when it should have been subtracted. So just reinforce those rules. All right. And then the last thing to this, once you got all those balances, the last thing you had to do was prepare the adjusted trial balance. So we're taking all those final totals that we got and we're placing them in this trial balance, the second trial balance that we do. There'll be three altogether. And then we just put the balances in accordance to what the normal balance is. So you see that we've got 5 asset accounts here. Their respective balances from the ledgers get put on the debit side because they all have normal debit balances. Okay. Accumulated depreciation is a contra asset, so it has an offsetting balance of a credit. So its balance goes there. And then all your liabilities and even your capital account, your owner's equity account capital, all normal credits. So all the balances go over there. And then the revenues are a normal credit. We only have one. All right, there it is, but it has normal credit balance. And then again, all your expenses have a normal debit balance like assets. So all the balances go there. And again, if you're still kind of fuzzy about the normal balance thing, just remember, I'm talking great now. Remember ADE, aid, all right, ADE. Assets, drawings, and expenses, those are normal debits. Anything not in that ADE word is a normal credit, all right? So, you know, if the laundry list thing doesn't work for you, maybe that other technique that I showed you to learn those does. Because you have to know for any given account title what type it is, and then, of course, what its normal balance is. Because then with that information, you know where it gets reported, and you also know what increases and decreases it. Very, very, very important. All right, the importance of that does not go away. In fact, it's even enhanced in this chapter. All right, and in chapter 4 too. All right, so when you do the math, and this is the moment of truth, I call it, you did the math and hoped that your bottom numbers matched. Some of you, that didn't happen, all right? You realize, okay, I'm off. Now, for a number of things that could happen with this one, if you've used all 3 attempts in your first part of the problem, part A, for the adjusting entries, and you had errors, naturally, those errors are going to work their way through the posting and, of course, work their way into the adjusted trial balance. We call that a carry-through error, all right, which is what it does. It carries through multiple accounting documents until it gets addressed. So don't worry too much about that. With this assignment was graded on completion, so I'm looking for effort. All right. So when I was working with a couple students, I told them they were kind of like, yeah, I go in there and everything's red. And you know, of the few that I met with, we worked through that. I kind of explained what was going on, and you know, and then just basically, when we did the review, like we did here today, to kind of connect the dots as to like, okay, well, I know this is marked wrong. You know, if you know why it was marked wrong, that's a great place to be. But even with my review today, going over this in the detail I did, if you're still kind of, you know, unsure as to why something was marked wrong, let me know and we'll look at it individually, okay? Because I want to make sure that the follow-up to this is not just to review the solution and move on. If you have some things after we did this that you're still unsure about, let's do something about that. Because if you don't fix that problem, that same issue is going to exist when you do this stuff again, all right? Which is really what the next homework is about, all right? All right. So I want to talk about the next homework. I know that, you know, part of today's class is going to be chapter 4. And at this point, it's looking like we're just going to get an introduction to that, which is okay. You know, because we're still in good shape there. But I want to do what I did before. All right, I'm going to blank my screen temporarily for both screens that I'm transmitting to. And I'm going to go ahead and create that assignment and show everybody what's going on there. All right, because there's a few things I want to say about it. So just let me get a second to actually make that available to you so we can go in there and take a look at it. So what you're going to do for homework is a little more of the same thing that we just did, but with one little twist. So this would be the 4th assignment for chapter 3. Oops, let me see here. Let me get that in there, and then we'll talk about it. So give me just 1 second. It literally will take me just a minute to throw that in there. Oops, actually, get rid of that. Go back in. Yep, I clicked the wrong button. So this would be the 4th homework. And, you know, this one, because of what you're doing in it, will also be a completion grade, okay? Because we're going to be working with financial statements in this new one. And then we'll probably have one more related to chapter 3 that will basically be a specifically graded one, right? To kind of wrap things up. So let me go ahead and grab that. Make sure I got it here. All right. Yep, this is the one I want. Okay. Yeah. So this would be the fourth assignment for this chapter. And okay, we'll move that. And I'm going to go to the next step. There we go. And so this will be due. I'm assigning it today. It won't be due until right before a class on Tuesday. So you have to the 8th to do it. And again, I usually make the time that it's due 1:30, about a half hour before class. All right, so let me throw that in there, and then I'm going to open it up, and I just want to review a few things with it. Okay. And I don't have the narrative in there yet, but we'll do that. I'll throw that in there after. Right now, I just want to go over it. Okay, which actually, you know what? I can throw that in there. Let me do that right now. Take 2 seconds. Why not? Let's throw it right in there. All right, so this is a single problem. And, but there's a few parts to it, which is why I want to go over it. And I think next Tuesday is the 8th. Yeah. Okay, there we go. Hit the submit button. All right. All right, so let me go in here. Whoops, make my screens available for both. All right, so we'll go into obviously the content area. That's where everything is. Under assignments, you'll see that I have the new one listed here. So I want to click into that. Then let's talk about it a little bit. All right. There is a single question in there, which is a problem. Okay. We got Hank's Hotel. All right. They opened for business on May 1st, and they got a trial balance adjustment on May 31st. So their time period assumption is 1 month, just like the one we just got done with. They got a trial balance here with some balances, of course. And so the setup is very similar. We only have 6 things that need to be adjusted here. Okay. Let me zoom in on that a little bit. There we go. And so for letter A, you're again preparing adjusting entries. Okay. And then what's going on with that third entry? There's 3 fields there. Oh, yeah, I'll talk about that. Yep, because I want to address that. So once again, don't do your homework like this. To make B be available, I'm going to use all my attempts, because again, you have to use all your attempts in the first part to get the second part. All right, so in part B, you once again are posting. And remember, if it says balance, you're grabbing the balance from the very top trial balance area. All right, you're going to copy that number down, put it in the balance column. Do not put anything in the debit or credit columns. Okay. And as you see, most of the accounts listed here have an initial balance you got to grab from the top. All right. And then some of them are going to be adjusting entries only. Some of them have a balance and then adjusting entry, like unearned rent revenue here. So you're going to literally do the same thing that you did with this first problem that I gave you for homework for today. All right. When you get all that posting done, once again, I'm going to show you the third part of this. All right. Go in instructor view, but I figure I want it to be exactly what you're going to see. So that's why I'm kind of doing it this way. All right. So once you have used all your 3 attempts for part B, then part C is asking for an adjusted trial balance. All right. And you know what to do there. We just got done reviewing that. You just got done doing that for homework. All right. So your final balances in your ledgers go in there. All right. And once again, I'll submit that like so we can see the next part, because there is another part here. There we go. So, and once we get past the adjusted trial balance, there is a part D. So they want an income statement, okay? All right, you got to prepare one of those. And then without really showing the other would be owner's equity statement, and then the last one would be a balance sheet. Now, what I would do for that section is they do have examples in chapter 3, but don't hesitate to go back to chapter 1 and follow the templates that were in chapter 1 for that soft bite company, if you remember them. Yeah, you can go to chapter 1. Yes, sir. Do you want to see it? Yeah, I don't mind. I'll show you. The homework one or the template? The homework one. Yeah, we can do that. I'll click through it. Yeah, if you want to see all of the basics here, it just means I got to use my attempts here.
There should be a page and directly down.
Oh yeah. Well, I got my mouse, my Apple mouse here, and I just a flick of the finger, I can have it do that. Yeah. So the owner's equity statement, yeah, there's the template for that. You got to put the necessary amounts in there. Some of them are drop downs, some of them are data entry. Okay. And yeah, just let me throw that down. And you know, the Apple mouse, you know, I paid, it was really more expensive than it should be, but I think it's pretty good. You know, and it's lasted a long time, so it's more than paid for itself. But so, and then the balance sheet, of course. Balance sheet, you have the assets section, and then of course you have the liabilities and owner's equity. So, and then that would be the last piece. So this is exactly like the same homework we just got done doing, but you now have that extra layer attached onto it where you're doing the financial statements. So now, kind of reaffirming this, if you go into content, go down to the ebook. And if we go back to chapter 1, which is another resource you can use, there's stuff in chapter 3 you can look at, of course, for financial statements. But, you know, just to, you know, remind everybody that the 4 financial statements section here, I'll even give you a page number once we get there. Yeah, in fact, you might even have it back in your notes. We have 1-22 or 1-23, you know, however it paginates, but you have these original examples here from chapter 1. You could use these. You could use these. These will give you something for a model to look at to help you pull in the headings and accounts that you need.
Yeah.
Yeah, so this 1-22, which is what I'm showing here in the bottom left there. If you want to kind of mark that down, I might even in the assignment listing throw a little note in there that, you know, follow the templates there. And then in chapter 3, if I go there real quick, chapter 3 is, there should be, yeah, in the trial balance and financial statements section, you should see there's a trial balance, but I think they also have illustrations like we saw in the slides as well. So you got one for the income statement, you got one for owner's equity, and then the balance sheet. Now, the one good thing about the chapter 3 models is that you've got, it's factoring in that contra asset, how that would show up or be depicted on a balance sheet. So that these are also very valid to use. Okay. The PowerPoint versions of these didn't look too nice, but these don't look too bad at all. Okay. In terms of models that you could use. All right. And, you know, I mean, you could try to do these without reflecting on the models, but, you know, why would you not go in here and just have that open and use it as a point of reference to find your headings and your accounts and all that stuff? For the liability or the expenses, rather, again, try to go from the highest expense to the lowest. Just make sure you don't miss any, you know, and, you know, that's probably what you would want to do for that one. And that is the homework assignment. It's a single problem, but there's 4 sections. All right. Yeah, that's you know, take your time with this. And, you know, the good news is you've already done this, you know, for like the first 3 parts. And then it's going to be a lot of deja vu, but, you know, take the notes and, you know, before I do anything, I'm going to hit that save button because it would be tragic if I lost everything that I typed in there. You know, access the notes, which will be attached as a downloadable document in the class recording I'll upload. And then just use that as a point of reference. We also have the earlier exercise where we did the same darn thing. You can have that as a point of reference. All of that is in your notes. All right. And I'll make sure I pretty that up a little bit so it reads better than the way it looks right now, because it looks like the paging got a little screwed up there. All right. Now, we got about 10 minutes left. I can start chapter 4, but I'm not going to. I can, and if I started chapter 4, I'd be like, well, here's chapter 4. Here's a list of things we're going to do, and have a good day. So no, let's not do that. All right. Yes.
For A, I believe that you said you're.
Oh, yeah. Yep. I forgot to address that. Yep. Thank you. Way back in part A, when you had to do adjusting entries, all right, you see the fields down here, but if you look at number 3, there's 3 of them. All right. So let's look at 3 real quick, talk about that. Thank you for reminding me about that. So 3 says annual depreciation is $3,600 on buildings and $1,500 on equipment. So what you're doing there, and we know I'm not really giving away anything. We know that this is depreciation. That's going to be that entry. We've got 2 different assets we're recognizing depreciation expense on. And in this problem, if it's in here, it's down here. We've got the accumulated depreciation buildings and accumulated depreciation equipment. All right. So what's happening is each of those have their own individual accumulated accounts, and depreciation expense is obviously going to be the thing that you throw the total into. All right. So you have 3 fields. 2 of them are going to be for those individual accumulated depreciation accounts. And then one of them is just going to be the total of the depreciation expense. So I wanted to, draw attention to that and kind of give you some pointers as to what's happening there. So, because you haven't seen it like that before. So this is what we would call a compound journal entry. All right. When you have more than one debit or credit, and not just one each, that's a one each is a simple journal entry, which is what all these other ones were. This would be considered a compound journal entry. Okay. You have 2 accumulated accounts, one for the building, one for equipment, I think was the other thing. And then the grand total will go in your depreciation expense account. Okay. Yep. So yeah, and then of course, look at the template in the previous examples I gave, and kind of use that as a point of reference, and then just understand there's going to be not 1 accumulated account, but 2. Okay. Yeah. All right. So somebody said dad jokes. You're glutton for punishment for what is basically the worst jokes in the face of the earth, but I like to tell them anyway. Here's one. Why won't cannibals cook instant noodles? Good answer, but no. They prefer raw ramen. Okay. Yeah. I need a sound file that goes wah, wah, wah. Okay, maybe I'll have that next time. All right. Let's see what else we got. What do you call a fish with no eyes? I like that you're trying to guess. A cant sea bass. All right. So a cant sea bass, okay. And I'll give you one last one. Okay. That one's too good. Some of these are just so nasty. I can't even tell them. They're just, yeah. Oh, this is awful. All right, but I'll finish on it. Why not? Track record is even. Why must you wear your glasses when doing math? Because it helps with division.
Okay, that was really bad. Never do this again.
Oh, should give you guys extra credit points just for enduring all that. All right. All right. So I'm gonna stop the recording and yeah. Oh my God.